Okay, this session we're going to go through the financial blueprint that I've followed for the last 20 years that I was taught to by my millionaire mentor. I want to talk to you and share with you the formula to create $1 million net worth in 10 years, the advanced formula to create $10 million net worth in 20 years, 8 steps to getting started. You need to be able to come up with ways to raise money to invest because that's important. We're going to look at the top 10 investment strategies for the year ahead, 2014 for the year ahead. I'll give you an economic update of where I see the Australian property market at, the Australian economy, the world economy, the US property markets, just my view, my opinion on those, if you would like. I will also share with you the new phenomenon in Bitcoin. What is Bitcoin? How do you profit from Bitcoin? And how you could potentially become a Bitcoin millionaire. One of the most exciting trends and phenomenon on the planet right now, especially in the last 3 weeks, it started to make it into mainstream media, where before that was very few people knew about it. And if you don't know about it now, you certainly will in the near future. So that's exciting. Then at the end of the session, you're going to have a 20-minute session with our guest speaker on really just going into a bit more detail on some of the formulas that I'll teach you, just so you have enough information to really lock that in. Generally in this session, I used to teach share renting, but we'll have my friend Nick teach you that tomorrow. Plus, of course, it's on the DVDs, so we don't need to go over that. It's already on the DVDs. That'll give us a bit more time to go into some of these new strategies. Make sense? Okay, so let's look at this financial blueprint. This is the blueprint that I followed for many years, what I recommend. Even though I'm qualified, have been over the years to be qualified and obviously licensed in the past to give advice, my goal is not to give financial advice. I'm an educator. If I wanted to teach you on the stock market, etc., I've taught that in the past, but we have our licensed speakers to cover that tomorrow. My goal as an educator is to teach you what's possible, what's been done by others. Ultimately, it's up to you as an individual what works out for you, what suits you. And Sunday night, I'll go through some strategies to help you identify how you fit all the different strategies into what might suit you. Because over today and tomorrow, particularly tomorrow, you're going to learn a lot of new strategies. Remember, we're teaching you, look at it like a buffet. Okay. In other words, if you go to the buffet, are you meant to eat everything in the buffet? Yes or no? Some people are not sure. Okay. No, you're not. It's there as a variety of choices. You take what you want. If you don't like spinach, well, you don't go stupid buffet. You take what you like, okay? What we're giving you is a variety of strategies. Tomorrow, there'll be some speakers. Some of the speakers will do a quick ad break at the end. If you want to enroll into some of their more intensive programs, you can. You certainly don't have to. But it's there to give you a choice. It's, there's plenty of education with the stuff that you're already doing. But some of you will want to be more advanced and do more intensive programs and go for it. I mean, that's what's worked for me. I've done a lot of that. Others of you will just want to focus on core strategies, which you've been taught, and you don't need to do any other programs to do those core strategies. Make sense? Okay? So it'll give you a variety of choices. And if you're not really sure which strategy suit you, then tomorrow night's session, when I finish the event off, I'll give you a way of working that out for yourself. Okay? So financial blueprint. Effectively what you're looking at is everyone really starts, the word we're really after, jot this down, is synergy. What is it? Synergy. So what we're going to do is the way to accelerate wealth creation, and say in Australia or pretty much Western societies around the world. I know we'll have a lot of clients from America watching this, and from, we've got over 17 different countries now we have members from. Most of these strategies are applicable to many markets. Obviously, we're going to talk about the Australian property market. That's unique in some ways, or the US property market's unique to the US. But many of the strategies outside of that are all fairly universal. So we all start off with a job. Is that true? Pretty much, if we're going to get started on wealth creation, we have to have some form of income. Some people, I've said over the years in the past, Jamie, what happens if I don't have a job? What do you think you should do? Get one, okay? Don't try and build wealth without some form of income, because it's just not going to happen in a hurry. So we all start off with a job. The most common way that people have created wealth in Australia is they've learned to save some of their income from their job, and they put their surplus savings into a what do you think? Into property, Australian residential real estate. And then over time, what has happened to the value of property? Over time, it goes up in value. That is, it's very simplistic, but that is one of the most simplest formulas that people have made money from in Australia, okay? They might only earn X amount in their money, so in their job, but property's making them money while they sleep. You've heard me talk about how to make money while you sleep. That's one way, because it goes up in value over at night while you're sleeping. Many people earn more money while they sleep than they do working 40 hours a week in a job over time. So we're being smart. So here, we're at work, active income, and now we have money at work. And if that's all you did, and I'm going to show you the formula to create $1 million net worth in the next 10 years, it's going to involve property. Now, what we also have made available, some people, where else can you invest? In the stock market, okay? And so a lot of people have done that. You've seen on the DVDs concepts like share renting. You're going to learn tomorrow from our licensed speakers. So what I've done in the past is I did do some of those strategies, selling insurance, etc., where I use some of my equity to generate cash flow. So I predominantly use those for cash flow strategies. Making sense? And you'll learn some of those tomorrow. However, here's the mistake, and I alluded to this yesterday. If you want to know what, would you like to know the biggest mistake most people make? Yep. So here's the biggest mistake, because people want instant results or want faster results, and property is like a 10, 20-year type vehicle, unless you're doing maybe US property or something, is they will, and this is the more certain, safe, conservative formula that has a high degree of success, is they'll jump into strategies here. There's a multitude of different strategies, and they'll only focus on that, when the way that I always did it was that was in conjunction with this, okay? So conjunction with an overall portfolio. Make sense? Those cash flow strategies combined with a solid capital growth real estate strategies can work well together. But if you take this out of the jigsaw and just do that, I think that's one of the biggest reasons people have not achieved long-term success. Go back to, say, 15 years ago. If someone was sitting in this event 15 years ago, I would have taught them the same formula, okay? Now, if they went out 15 years ago and bought a property, and then, say, in their second year after the event, they bought a second property, would they be incredibly happy today, yes or no? Because over 15 years, let's say in Melbourne, 15 years ago, they bought 2 properties. It'd be very hard for them not to be a millionaire today. Make sense? It'd be almost impossible for them to not be a millionaire. Didn't have to do anything other than just that basic formula. But if someone 15 years ago sitting in the event and go, okay, I saw that, I could do property, but I really just want to make cash flow quicker, and jumped into stock market strategies, and they may or may not have succeeded. Or they may have made some money, but then they got preoccupied with other things and didn't keep at it. They wouldn't necessarily be a millionaire today. Does it make sense? So that would probably be the biggest mistake, the people that haven't built the basic formulas we teach, and then not understanding that the reason we teach the other things is an add-on if you want to do it, not as the core strategy. Who's following what I'm saying here? Okay? So I just really want to make sure you keep it really simple and do the basics first, have them underway, then add on some more sophisticated things if you want, but you never necessarily need to, okay? Because it's not just what's possible, it's got to be sustainable as well. Why real estate is great is that it's, jot this down, it's a set and forget strategy, pretty much. Set and forget strategy. So once you've done the hard work, you would have heard Conrad speak last night on finance, is that true? For those who are here, like finance is really the hard work. You know, property investing is not about buying property. If I said today, I'll put a gun to your head, you have until Monday morning to find 10 properties that you'd want to buy by Monday morning. Who here could find 10 houses to buy by Monday morning? That's not the hard part, is it? Who here could find 100? You could do it now. You just go to realestate.com.au and there you have it. Okay? So that's not the hard part. And even if you didn't know what you're doing and just bought any property, you're still going to do well long term. So the hard part is getting finance and getting the deposit, except that's the hard part. So it's really, property investors is more about getting the finance, okay? If the banks would loan you money for 100 properties now, say 100% finance, you didn't need any deposit, who'd consider buying 100 properties now? They'd give it to you, okay? Obviously you have to fund the negative gearing, but if it was positive cash flow, you'd certainly do it because you'd be able to afford to do it. So the hard part is it's that magic bank account, getting those magic bank accounts open. That's why you need financial help with our finance experts, etc., because there's a big difference in what some brokers will get you compared to others. So you need, when you've got access to finance brokers that really know the tricks of the trade, they're more likely to be able to assist you in getting loans, okay? So that's a free service available for you. You can see the property guys with the finance team, and at least to get a review, because a lot of people think they can't invest in property. They perhaps can, but at least find out first. Okay, at least find out what you can afford. Or if you can't afford anything right now, they can put you on a plan and go, well, we do this, this, and this, and X amount of time, you should be able to afford this. At least you know where you're at. Make sense? Because it's nothing more frustrating than wanting to do something but not being able to do it. So this is by combining more than one strategy, though, can accelerate what you do. And that's what I did. Now, the next step is you can turn your job and what we teach people into the time-rich concept, where you free up your time and increase your income. But you can also, I guess, start a business. Okay, so you can put in here, you can start a business. And that's the other pillar of creating wealth. Now, we have a business program that you can get on Home Study, etc., and that we do. We'll teach you about business. And then the other aspect of that is also you can do internet businesses, which is... And you learn strategies tomorrow on blogging and internet businesses. So by adding this is what you're boosting your income. Now, here's the other mistake. Would you like to know what the other mistake is? Yes or no? Yes. So the other mistake that I've noticed, because obviously when you've educated hundreds of thousands of people, you start to pick up patterns of success and failure. Patterns of what people have done as 20th century members that had them very successful, and patterns of what people have done that's had them fail. Okay, and not get the results they want and end up in frustration or quitting. Okay, so the other mistake people make is that they're so focused on just wanting to replace their income because they don't like their job, they want to retire as quickly as possible, that they neglect their career or neglect building businesses or neglect building other incomes and just focus on wanting to rely on their investment income. And the mistake that is that what you really want to do, and what I did, is that I rejigged my career, got onto a 21st century working contract, and I massively increased my income from my job, etc. in the beginning. I didn't neglect it. I massively increased second and third incomes. There was no internet back then, so there wasn't that opportunity to do internet-based or blogging and that sort of leverage social media type stuff. But I could build other incomes on the side, and that's what I did. And I used those incomes to fuel property acquisitions. Making sense? And I even learned, even when I didn't have a lot of money for deposit, how to get into property and be creative with using creative financing or ways to negotiate to get into property without having to use a lot of deposit. So, and things that you can learn on the DVDs. So as a result, I continue to fuel this, which sped this whole cycle up. You never ever want to get to, you want to get to a position where you don't have to work. The goal is not to not work. Does that make sense? There's a difference. The goal is to get to a position where you don't have to work, but the goal is not to work. In other words, what you want to be able to do is move to careers that you're passionate about and love to do, and you'll end up making more money from it because society rewards what? Passion. And also you're developing all these skill sets where you can add a lot more value to society. And as a result, you make more. So then you can speed that up. So that's the other mistake people have made. One, spending all their time here on trying to do more get-rich-quick type strategies, okay, over here, and neglecting their income here, and neglecting the more set and forget, more solid long-term wealth strategies. You don't have to do anything more than a strategy. If you're going to only do one of these investment classes, which one do you think is most likely to succeed for you long-term? Yeah, I would say here. Now, some of you are thinking, well, Jamie, but, Australian property is really expensive, but some people say it's overvalued. If you read some of the newspapers, they say we're going to have a property crash, and it's all right. Yeah, sure, people 15 years ago or 10 years ago bought property. Yes, it's doubled or more than doubled. Doesn't mean, but what about in the future? Is that going to continue to happen? Who has some fears and doubts around this or not even sure? So what I'll do is that in a moment we'll go through and I'll give you a bit of an overview of where I see that at, okay? Well, let's cover it now. So my view is that what you understand is this. Let's see if we can figure out the fundamentals. Now, back in the credit crisis, in 2008, there was a lot of economists and a lot of analysts or just commentators that were saying that the Australian property market's going to crash. Okay, even IMF and these different organisations were saying because Australian property is overvalued, it's overpriced, it's going to crash. Now, see, here's where a lot of analysts it's funny when the media takes notice of stock market analysts for their views on property. That's when you really know they're off track. Because what the hell would they know? The first thing you should go, if you're going to listen to someone commentate on property, are they a property millionaire? That's the first thing I'd want to know. Because are they talking gibberish, theory, or they're actually out there, do they own millions of dollars worth of property? I think that's a more qualifying issue to know, because someone is that, if they're a millionaire from property, they would have certain insights that those who just commentate about things don't have. And two, they're putting their money where their mouth is as well. If you're actually investing in property, you're not just saying, oh, you can make money from this, or you can't, but you're actually doing it. That's a big difference, because you're actually backing up what you're saying with some action. So a lot of people back then were saying, property market's going to crash. It's because it's overpriced and overvalued. I went on radio at the time and said, I disagree. I don't think we're going to see they're saying 40% crashes, 50% crashes like the US property market. I said, I don't believe Australian property will crash to that extent. We might see a flatlining of growth or a slight decline, but I don't see a major crash. I would see an increase of 20% before you'll ever see a 40% crash. Now, fast forward from then, cities such as Melbourne had an 18% increase not long after that. So the point is, why was I and others more bullish and confident about Australian property withholding its market value, or increasing in some areas, where others were absolutely certain it's all over and was going to crash 40%? Well, first of all, is that we have to look at the fundamentals, okay? So let's teach you now the fundamentals of real estate, so you don't have to rely on someone else's predictions or opinions. You can make up your own. Make sense? It's really just common sense. So let me ask you this question. Is Australian property expensive, yes or no? Yes. Absolutely, it is expensive. Is it overpriced? Well, that's a debatable one. I'd probably say in some cases, yes, it is overpriced. But here's what I would say. Sydney property was overpriced in the 80s. Did it, just because it was expensive and overpriced, does that stop it going up in value, yes or no? No, it hasn't. So this is where a lot of the analysts and commentators get it wrong, because they go, it's expensive, it's potentially overpriced. And they go, therefore it must be going to crash. Not necessarily. That's where they get it wrong. Because what determines the value of property? Well, it all comes down to demand, isn't it? Any product comes down to supply and demand. Now, does Australia, so immediately through the credit crisis and up into maybe a year ago, property was pretty flat in a lot of areas, particularly in Sydney for 5 or 6 years it was flat. Melbourne actually did better in that time. Some areas of Melbourne have grown quite well, and the good suburbs of Melbourne generally will always grow. Why? Because do people want to live in St Kilda, yes or no? Yes. Do people want to live in Toorak, yes or no? So there's always such a demand that if people want to sell their homes, there's other people who want to buy them. So in a lot of suburbs, you're always going to get certain demand. That's why you have to pay more to get into them, because more people want to live there, okay? So what drives property prices? So how I made my decision through the credit crisis that it wasn't necessarily going to crash, it was that one, did Australia at the time, and still to this day, have increasing population or decreasing? Increasing, slight increase or massive increase? Back then, back 2007-08, was a 330,000 a year increase. It was at its peak of migration. So if you knew that, you're going, hang on a minute, Harry Danson, I've had Harry speak at my events, one of the leading economists and others were saying, it's going to crash 40%. I said to Harry, Harry, we're not going to put you on the main stage at the Financial Education Summit. You're going to be in the side room. The reason is I like a lot of your work. I've followed it for years, but when it comes to the Australian property market, it's just not accurate what you think. And I don't want you scaring the hell out of everyone, okay? So you're in the side room, buddy. So, but the point was he had it wrong. I said, Harry, and I even interviewed. There's an interview with me and Harry, and I talked about it. I said, Harry, I agree with you on certain markets in Australia. There's certain markets in Australia that are like the Miami in America, or like the overpriced markets were in America that caused a property crash in America. Because everyone thought the US property crash was because it happened there, and in the UK and Ireland it happened, it was going to happen in Australia. But once again, if you knew about the different markets, was the Australian property market fundamentals very different to the US, yes or no? If you knew enough, massively different, okay? For instance, was there an oversupply of property in Australia or an undersupply? There's been a chronic shortage of undersupply of property in Australia for a long time, and there's various predictions of the future shortage. But Australia, you notice one thing about Australia, it takes forever to build anything. Like they're talking about building a fast train network, which we've been pushing for years. Now, if we were in China, they wouldn't have talked about it. It would be built by now. China could build it in 3 years. They're talking about 30 or 40 years in Australia before it'd be completed. That's like, really, they're talking about a second airport in Sydney. They're saying, well, it wouldn't start to 2016, it wouldn't be finished to 2030. I'm thinking, so houses here, houses in Australia are ridiculously expensive to build. Like if you go to America, who's been to America and looked at some of the houses and stuff? When you see some of the houses over there, you just can't understand, and some of them are decent houses, how cheap they are and how cheap it is to build things. Pretty much in Australia, we pay 3 times for everything. Walk down this road here, down Kingsway, and I walk there to work every day. Our head office is in Kingsway. It's that pretty blue building, 222 Kingsway, the Mercedes-Benz logo on top, which we're also getting removed soon. The point is that you walk past BMW car yard and they had those mini, whatever they are, those little bugs or whatever, Beetles, those other cars. Some of them are like $70,000, $80,000 for a little V-dub. And I take photos of them and going, this is ridiculous. Anywhere in the world, they would just know. You can buy a Lamborghini, second-hand, but only a couple of years old, like phenomenal car in America for $80,000, $90,000, which you'd pay $300,000 for the same in Australia. Do you realise that? So we just pay so much. Houses here that you would pay $500,000, like in Sydney, you'd pay $1 million for a dump. Yet in America, there's places you can get a mansion for $1 million. Clothes, everything. We pay a fortune here. So why that is a few different reasons, but the point is we get ripped off, basically. We pay a lot for what we do here. Point to the story is there's a chronic shortage of housing because it's so expensive to build. It takes forever to build. Therefore, in America, though, was there a shortage of housing or massive oversupply? There was a massive oversupply because what really caused the credit crisis was the lax lending that allowed a lot of property to be, the construction industry grow, and that was, people could see that coming. So there's a lot of oversupply. So the fundamentals were very different. If you understood that, you go, well, Australia is a different market. So it doesn't matter what the so-called experts are saying, let's stick to the fundamentals and see if it's real or not. So Harry Dent. So I said, Harry, the markets that I agree with you, though, that are going to crash are the markets that are such as Gold Coast, Sunshine Coast, and those coastal markets where people have a second home. Make sense? Because in a credit crisis, 2008, 2009, what happens when people tighten their belts? Do they sell their family home first, or they sell their second or their holiday home first? Therefore, Gold Coast, Sunshine Coast, in Perth, Mandurah, in around here, probably Torquay, some of those places would have seen a price decline, okay? Or in the snow, in the mountains, price decline, okay? Why? Because people get rid of them first. So if you understand that, you go, well, that's where you did. So in the Gold Coast, mansions on the Gold Coast dropped as much as 60%. If you want to buy the best bargain in Australia right now, a nice home, buy them on the Gold Coast now. It'll be your last chance to buy them. You could buy mansions that were $5 million for $2 million, and you could buy them now. Sunshine Coast, probably the same. But you'll never see that again. They'll double in value, I'd say, within 3 to 5 years. So if you want a total bargain, you can afford that, that's what I would be doing, okay? You'll never see Gold Coast prices like that ever again. It's the drop is right down and starting to come back up now. Make sense? So I'm very bullish on the Gold Coast. I live on the Gold Coast, so I know the market, but I'm very bullish because it's had a downward cycle. It's hit its bottom, and now it's bouncing off its bottom, and you're going to see pretty good growth there. And it's got, if those mansions double, they're only barely back to what they were along, 5 years ago. So they easily can double. There's plenty of room for that. So outside those markets, though, the other markets, they didn't really crash. Some of the cities pulled back a bit, but through a credit crisis when everything else is going, falling apart, you could, with real estate, you didn't really have to lose any sleep over it. Because what's the worst thing? If the market drops, do you rush out and get a valuation done every day on your house to see where it's fluctuated to? Yes or no? You don't really care. I mean, if you own a house or property and intend keeping it 5 or 10 or 20 years, even if the market dropped 20% in the short term, are you really bothered by it? Makes no difference to you. It's the Warren Buffett approach. He has the approach you have to property is what he applied to the stock market, and that's why he's so successful. He says, you should only buy a stock or something if in if the market was closed for 5 years and you couldn't sell it, would you be prepared to buy it? And same with property. You should be buying property, jot this down, buy property to hold for what? Long term or forever. You should ideally be buying property to hold forever. Buy and hold. It's the number one strategy in the top 10 that I'll go through, investment strategy, because it's very fundamental, and buy and hold. There's people who sold some property in Australia that they now regret they sold. You know that if you kept it, you'd be much wealthier to this day. Even if you got ripped off on free flights to the Gold Coast all those years ago and bought an apartment or a house on the Gold Coast, remember those real estate scams? Even if you bought one of them, overpriced, if you kept it long enough, you would have become wealthy. So even if you totally stuff it up, property is very forgiving long term, okay? That's why I guess Australians love property. Now, the Reserve Bank, and they may not like me saying this stuff, it's like we don't want people hyping the market up, but I'm not telling all Australians this, am I? I'm just telling you guys, okay? There'll be enough people that won't do it to make sure the small percentage that do profit. Now, some people say it's not fair, the young people or some people, poor people can't afford to get into property, it's too expensive in Australia. Well, that's just the way it is. We can moan about it, or we can take advantage of it. Are we going to be a victim of it, or are we going to be a successor of it? Okay? And that's just the way it is. So, as a result of that, we could start to see that, okay, let's look at the fundamentals. So therefore, I was able to preempt that the market wasn't going to crash. So what I did do at the time, though, I started 3 or 4 years ago buying US property, because I realized, well, hang on a minute, that's the bottom of the market, or predicted, it's comfortable to do as close to the bottom of the market. Why not start buying that as well? So I diversified because I was going to see a lot of upside, an anomaly in the market where you could profit from that. So tonight, after dinner, you're going to learn about US property, those who are interested. I'm still very bullish on that, and we'll talk about that in a moment, okay? So let's look at the fundamentals. As a result of that, the property markets, stabilized, and over the last few years, they've been a bit flat. But now what we're starting to see, a year ago, I started saying to everyone, if you've been following what I did, I started saying, I'm now bullish on an upswing in Australian property. I said, starting a year ago, the next 3 or 4 years, jot this down, the next 3 or 4 years, you'll see some rampant growth in Australian property prices. A year ago, if you said that publicly, most people thought you were nuts. Why? Because they're going, they're still worried, property's not going to go anywhere. Now you see it in all the papers, particulars from Sydney would see auction clearance rates as high as 90%, some of the record clearance rates they've ever had since the last property boom, even higher. And Sydney property prices this year have risen substantially. Like, there's massive amounts of people at auctions to try and buy Sydney property. Now, admittedly, Sydney was flat for 5 or 6 years, so if you understand the plan that we're going to talk about, let's go through 8 steps very quickly before we get into this. Jot this down. 8 steps to come up with money. So then we'll look at real estate as one of them. Number 1, you can save some money. So if you don't have enough money to invest right now, if you're a saver, you would have some savings aside. If not, start saving. Number 2 is sell something. So maybe you have some liquid assets that you can cash in. Maybe you have a spare car, spare couch, some spare furniture, spare fridge, spare boat, spare spouse, spare kids, whatever. Liquidate them, okay? And you'll get a better one later. So you sell something, you might be able to raise some cash. The other thing is tax. Many of you are paying copious amounts of money in tax. Investing in property is a great tax strategy, so you utilize it. If there wasn't a negative gearing on taxation in Australia, Australia wouldn't be worth investing in because the taxes are so excessive otherwise. Negative gearing is the best, jot this down, negative gearing is the best legalized tax scam in the history of the planet. Notice legalized means it's legal to do. It is a great tax scam, but it's legal. So take advantage of it. They need to do that because the government doesn't want to have to develop property. They want you to go out and develop property because there's all these people that want houses. If you don't go and invest in property to put a roof over someone's head, then the government has to. So they give you tax breaks to create that. Does distort the market, but that's just the way it is. So a lot of you, Warren would have spoke about this last night, they'll speak to that by investing, and Conrad will talk a bit about it tonight, or have some coaching sessions with those teams, and they can explain the tax benefits of investing in property if you're not familiar with it. But what it means is some of you, the government is taking tax money, they'll let you have that back to pay towards your properties. So if they'll let you legally do that, you might as well do it. Does it make sense? You'd be crazy not to. I see a lot of people, they're paying all this tax. I said, do you have an investment property? Like a school teacher, a friend that I have. And she's earning decent income because teachers get paid pretty well. And so like, you don't have an investment property. It's like, I haven't really thought about that. And she's old school, it's just going to get married. She's not worried about her own independence. I'm going, like, you might want to consider taking care of your own financial independence. So now she's looking at buying a property. So she can save a lot of her tax, and that can pay off that property, and she can start that pathway to becoming wealthy. Number 4 is income. Look at increasing your income. So we talked about that before, how to restructure, how to negotiate a pay rise, etc. So go to work on that. By boosting your income, you've got more money available. So if you boost your income by 20%, there's 20% you can put towards your savings to get more money for investing. Number 5 is OPM, which is what? Other people's money. So sometimes you can borrow money to invest. People have done that. It's up to you what you do. It depends where you invest it. But you can borrow money to fund investments. Number 6 is equity. So let's say, as an example, you have a house that's worth $400,000 and you have a debt of $200,000. So you still owe the bank $200,000. How much equity do you have in that house? So you have equity of $200,000. You owe the bank $200,000. That means the other $200,000 is yours. What you can do is speak to the finance people. You can get a line of credit through on your house or on your property, generally up to, say, 80%, subject to your income. 80% of $400,000 is how much? Of 400,000? 320? So what that means, say 320 here, you can increase your loan basically on your house from the 200,000 debt you still have, and the bank will let you increase it up to 80% of the value of the property, sometimes higher. In that case, it'd be 320,000 you can increase the loan to. You owe 200, so that gives you how much equity? There's $120,000 there that you can pull out of that property if you wish, and do what with it? You can buy more property or invest it wherever you choose to invest. Now, the ads are often CBA or other banks will run ads saying, especially before the credit crisis, increase your line of credit, pull out the house, go on a world holiday, buy boats and that sort of thing. I don't recommend doing that, because that would be considered bad debt, because that's bad debt is debt you have to continue to work for to pay off, okay? What you want to do you don't want to do a Nathan Tinkler, made all this money and then put it into non-cash producing assets. What you should have done was put into cash producing assets, then the money you make off that, then you can go and waste it, because that money's coming in without needing to work. Make sense? So you've got to be a little bit more patient, but you don't want to be the doctor's lifestyle. You earn a high income, but you leverage yourself up. So if you stop earning that income, you can't afford your lifestyle. You're better off investing that money. Then your lifestyle comes off the money off your investments. That way it's passive, no stress. So debt's not a problem if it's paid off by money that's coming in without you needing to work. Okay, it's no longer such a problem, because debt's a problem when you have to work to pay it off and something is going down in value instead of something, debt on a property that the property is going up in value is considered good debt. Okay, so there's 120K, because some of you, as we go through these strategies this weekend, you'll be going, where can I get some money from? You don't realize you're sitting on equity. Now, some of you will go, yeah, but Jamie, it sounds risky. I've been paying down my house to $200,000. I don't really want to risk my house. True? Understandable. So what we've got to understand is this. Jot this down. It should be in your notes from yesterday. Risky compared to what? We have to compare that, okay? So let's look at the most basic formula. Well, as an example. Let's say this is the formula to make $1 million net worth in 10 years, okay? Are you ready for it? Yes. Who's excited? Yes. $1 million in 10 years, okay, what the average person can do if they follow this through. And we're making some assumptions. We'll go through those assumptions and you can test those assumptions, see how close it is to reality. Let's say what you can do. Person A, let's say person A goes, nope, I'm not going to borrow against my house. It's too risky. I'm just going to continue to pay down my debt. That's person A. Person B goes, I'm happy to borrow against my house, and a risky compared to what? Yes, there's a risk, but I'm going to invest, pull some of this money out and put it as a deposit on 2 properties, okay? So over the next 2 years, they may buy 2 properties. Let's say the properties are $400,000 each. Can you buy properties for $400,000 still? Yeah, and some out of the suburbs, etc. The average Australian property price now is around $550 to $600, subject to where you are. It will vary, so that's below average as far as prices. But do you have to buy investment property where you live? Yes or no? You can buy it in different markets. Do you actually have to buy a house first, or can you buy an investment property first? You can do whatever you want, but so there's a lot of young people go, should I buy a house? Sometimes you can buy an investment property first, especially if you live at home. Like, milk that advantage as long as you can, okay? You get your investment property, get it all set up before you leave home. Like, your parents really aren't that bad, okay? You just arrange it, just get away with whatever you can. So, and a lot of people do that now, especially different cultures. It's normal from certain European cultures, etc., people stay living at home until they're 30 or 35 or until they're booted out. So what person B does is they're willing to put a deposit down in 2 properties. Now, let's go 10 years into the future. Okay? What do we expect these properties to be worth 10 years from now? Who willing to make an assumption that they could, no guarantee, they could possibly double in 10 years? Who's willing to accept that? If you're not familiar with real estate, what you would do is go back 10 years ago. These properties, if they were around 10 years ago and you're buying them $400,000 today, what would they have been worth 10 years ago? About $200,000. Okay? 10 years before that, if they were around then, what would they have been worth? $100,000. Now, if you're not sure about that, go on Google and go and research the suburbs, etc. When you see that has actually happened time and time again in so many suburbs, you'll start to get the natural understanding that, hang on, what you're getting is certainty that this is for real. This is not just some hype or, etc. It's a reality to it. No guarantee in the future, but hindsight's giving us indication of what's possible if we look forward into the future. Now, there's a lot of people out there, they'll say, well, that's all right in the future, but who says property is going to double in the next 10 years? But think about it. If we were 10 years ago, guess what people were thinking? Not really sure property is going to double in the next 10 years. Therefore, some people didn't do it. Some people did. Go 10 years before that. People are thinking the same thing. Do you know what I'm saying? It's in the moment we have to get ourselves to act. If you knew for absolute certainty, then everyone would do it. Does it make sense? There has to be some element of risk or uncertainty to stop those people that can't deal with uncertainty from doing it. to give you the opportunity that can deal with uncertainty to profit immensely as a result. Okay? Other people don't necessarily want to own it. They don't want to have the hassle of doing all that. They're happy just to rent as well. Is there a lot of people happy to rent for life? There actually is now. That's a growing trend. A lot of people, in a lot of cultures in Europe and stuff, people don't buy property. They just rent for life. So that you'll see is an emerging trend, which means there's an emerging market for you guys, if you want to be a property investor, to meet that market and provide a house for people to rent off you for life. So let's say we go 10 years into our future and we have properties that are worth $800,000 each. Now, if you look at Sydney and Melbourne, it's actually in the last 20 years, property has been ahead of the trend. It's averaged about 7 years. It's actually, in many places, tripled in that 20-year period, not just went up twice. Make sense? But let's average it out to 10 years. Now, there's two types of people in the world. There's people that come up with a problem to every solution. Who knows some people like that? Yeah, but what about this? Oh, that the naysayers, the critics. The other smaller percentage of people in society is the people that find a solution to every problem. Which one do you want to be in? A problem to every solution, or be someone that finds a solution to every problem? Or people who become millionaires find a solution to every problem. So let's say this 10-year assumption didn't work. And let's say it took 15 years for the next round of properties to double. Is a 15-year plan better than the pension plan? Yes or no? Yes. Is it better than no plan? Yes. And people will say, oh, it's risky. What they will do is they'll go out and buy a car. They're too scared to invest, but will buy a car. They'll buy a $50,000 or $60,000 car in 10 years' time, which is worth what? $5,000 or less. Okay? A guaranteed loss, which is historically absolute, total certainty that's going to happen. But investing is risky. Do you know what I'm saying? Or they'll buy lotto tickets when unlikely chance of ever winning. So they're actually taking more risk. Actually, not to be doing this is greater risk than to be doing it. Let me explain what I mean. That's why we have to balance up risky compared to what. Otherwise, people out there, it's risky to do something. So, it's risky to not do anything as well. So we have to compare apples with apples. Then we have to make a decision knowing that either direction carries risk. It's just, as a sophisticated investor, I want to minimize my risk by increasing my return. So I'm going to take a calculated bet. Therefore, compared to the risk that most people take, I'm not willing to take that risk. Inaction, to not do something is a decision to not act. True? So let's look at this. In 10 years' time, let's add up your equity. Let's say you put a 10% deposit into each of these. Over 10 years, what's happened to the rent? It's gone down or up? Generally, every 7 to 9 years, rents double as well, by the way. So the first 3 or 4, maybe 5 years, you may have been negative geared. But eventually, your rents go up. So over time, has the debt on these decreased, yes or no? Yeah, no, whatever it's about, and you might have been paying more principal off as well. So it would vary subject to how much you've been paying off. But the debt would have certainly decreased on these, okay? But let's look at the total value of the two properties. 800,000 and 800,000 comes to what? How much total value of the two properties? 1.6 million, okay? Let's assume you've only paid down the debt to 300,000. How much did you borrow originally? If you put 10% deposit in? 360. So to say the debt's come down to only 300,000 after 10 years is being pretty conservative, isn't it? You've had excess rent, you might have been paying principal payments as well if you wanted to. So it's probably come down a lot more than that. But let's say that's all it has. So you've still got 300,000 in debt on each of these properties, which is effectively 600,000. So what is your net equity in the two properties? How much? $1 million? Is everyone okay with that? $1 million. So So you've still got debt, 300,000 on these properties, you probably got less. That will give you $1 million. Is that $1 million in 10 years, yes or no? Yes or no? Is that a simple formula, yes or no? And that's assuming that property will do what it's done in the past, or a little bit slower than what it's done in the past. Now, if it doesn't do it in 10 years, it does it in 15 years, are you going to be okay with that? You're still better off, okay? Making sense? Now, you might say, well, that's all right, but how do I buy 2 properties in the next 2 or 3 years? Well, that would be the next step, how to figure that out. The key would be getting your first one if you haven't bought property before. Who's already bought property? So many of you are already underway or been doing this journey. So if you're keeping it really basic, that's what you're going to do. Okay? Figure out to get your first one, and then often the second one's easier because you're sometimes using the equity out of the first one. True? And then you're what we call leapfrogging your way up. Okay? The first one is always the hardest. But if you had to save up the deposit, do what you want, you want to get into that game because you're losing if you're not in the game. Now, the difference is, this is person B. He's done that. So he has made $1 million over 10 years while he's sleeping. Let's say the person that didn't want to risk pulling some equity out of their house or finding the money from somewhere, and they've just paid off their debt. So they now might have paid off their house, but they have no investments. So they are basically, they've missed out on $1 million over 10 years. Now, for them to catch up, they would have to win lotto to catch up. True? They effectively have been buying lotto tickets for 10 years to try and become wealthy. Yeah, their friend that's in the same job, same income, decided a decade ago to go and buy 2 investment properties. And they don't need to win lotto because they have $1 million net gain they've made while they're asleep. They actually have won lotto. Who's following what I'm saying here? Isn't it amazing? People spend so much time and money on buying lotto tickets when the wealth formula to become a millionaire is so blatantly simple, so blatantly obvious, that we'd be going, why doesn't everyone do this? But we know why they don't do it, don't we? What are some reasons why an average person doesn't do this? Fear. We talked about yesterday also, they link pain to the negative gearing aspect of putting some money out of to fund the shortfall in the rent and expenses in the beginning. Pain, so they know they should be doing it, but they back away because they're not thinking of the magic bank account, how that money is credited every year in capital growth. What about the fact that they want to spend their money now, they don't want to just put it aside or save or invest it? Those things. One, they're uneducated. Two, they're not prepared to invest or go to a seminar because everything say what? Everything's a scam, nothing works, or only for the lucky few. And how could you get rich in a rich country? Hello? Even though they live in a street where if they went down the street and added up the value of every house in the street, they're surrounded by millions and millions of dollars, and they're like, shit, I just want to get wealthy, I don't know how. It's like, I'm just going to go buy lotto tickets. I just don't know how how else can you become wealthy? And they're surrounded by millions of dollars, and they would have to know someone that's become a millionaire through real estate. Even though they didn't know, just walk down the street. Most people, they paid off their house in Australia. A lot of people are certainly close to being millionaires. So it's really kind of ridiculous, isn't it? But the great thing is, imagine this. Try this on Monday if you want to see why most people are not wealthy. Stand on if you work in the city or wherever, go to the ATM, get some $50 bills or $100 bills, and go out on the street, Collins Street or somewhere, stand on the corner and start trying to give money away. Try and give it away. And watch what's going to happen to most people. They're going to look at you and go, what's the catch? Or hang on a minute, like, it sounds too good to be true. There's something not right. They won't take the money. Do you realize that? Repeat after me. Something to think about. See, with elephants, and I would never allude and use an elephant as an analogy to compare humans, of course. But imagine elephants. Do you know how they train them? Elephants, when they're a baby, they put the chain around their ankles and they peg them to the ground so that the elephant knows it can only walk so far away from the peg. And they keep on trying to move further, but the chain cuts into their skin. And eventually they keep on trying to move, it equals pain. Does it make sense? It's like it's cutting in, and it's quite cruel. But eventually their brain goes, they keep trying to move too far away from that peg, equals pain, equals pain, equals pain. Wiring the brain, conditioning the brain, social conditioning, condition. Eventually the elephant figures out that maybe I'll only walk to this perimeter, this invisible barrier, because if I go beyond this invisible barrier, it's going to equal pain. Make sense? So once that elephant's been conditioned, guess what they do? They take off the chain. They just have to put a rope on to the peg. Gigantic big elephant now, because they have good memories, remember? That gigantic elephant that could easily smash that rope or pull that peg out. And there's nothing, no barrier around them. It's an invisible barrier. That gigantic elephant will not go past that invisible line. Who's following what I'm saying here? They've been so conditioned by past pain, therefore they have limiting beliefs, and even though we all know they're more than capable of stepping beyond that barrier, they don't. That is the power of conditioning. Repeat after me. Something to think about. Which is great, because we don't want everyone doing it. Okay? So do not tell all your friends this is a formula to become wealthy. The Reserve Bank doesn't want you telling everyone that because they're worried it might create a property bubble. And that's what happened in America. Because when the taxi drivers become property developers, check my Facebook and see what I say about future property, okay? When the taxi drivers are telling you stock tips, you're out of the market. So that's a taxi driver test. So what happened in the US is everyone was a property developer. They were quitting their jobs and because the property market was just going up and everyone was doing it and they did inflate the market. So the market has to be held in balance. So that's why we always want a lot of naysayers, etc., to balance the market. And we don't want a rampant growth in property. If you're a property investor, you just want steady growth over time. You don't want the rampant up and down because you don't want that volatility. Now, the good thing about real estate, why I'm bullish on this, is because if there was a property crash, is it really your problem or is the problem the people that have loaned you the money? It's really the problem that people loaned you the money, which are the top 4 banks in most cases. So some people, here's the crazy thing, some people don't believe in the property market. They think it's safer just to own bank shares. Do you make sense? But if the property, because they're worried the property market might crash, so they just own bank shares. It makes zero sense, does it? Because if the property market crashed, I wouldn't be owning bank shares. It's the bank's problem, not your problem. So I'm going to predict, I'm going to assume that the banks can afford the best research, the best analysis, and that they know and confident about the future of the property market because they have everything to lose if they're wrong. Does it make sense? I trust their judgment. And actually, you'll see a lot of the reports in the media that all the people these people that are talking to get a headline saying the property market's going to crash, go and read what the banks say. They usually will come out with very level-headed, no, we don't agree with that. We don't agree with the IMF report. We see that property prices will have steady gain. We see there's increasing demand and there's no reason to suspect we're in a property bubble. That's what they'll say. And they're right. Now, the other thing which you understand about banks, whether you like them or not, is here's the banks control the Australian property market. Can banks turn on supply at any time? Yes or no? Yes. In other words, to turn on supply of more houses, they would simply increase the loans to who? To developers. Okay? Developers then could build more houses. To increase demand for those houses, they can turn on the lending to who? The home buyers or investors to make it easier for you to be able to buy more property. That increases the demand, increases the price of property. Make sense? If they want to reduce supply, can they turn the tap off to developers? Yes. If they want to reduce demand, can they turn the tap off to home buyers and investors? Yes. They fully control that. So if they have trillions at stake, are they going to take care of the property market so you don't really have to worry about it? Yes or no? Yes. Yes. Okay, and if they're not, the Reserve Bank will be all over making sure they do. The government wants a steady increase in property prices. It's good for winning elections. It's good for keeping people feeling like they're wealthy. It's good for the construction industry. So they also want that as well. Okay, that's why they're unlikely to remove negative gearing, etc., because they don't want to affect that market. Okay, making sense? So that's a simple formula. Now, if you want more details on that, you can speak to the property guys, do consultations, but Conrad will speak some more before dinner tonight on some of that. There's also some other free events that we do from time to time, just specifically on property. Going into that into more detail, you're welcome. He'll tell you a bit about some of those. So how do you take this, though, and advance this formula? Okay, how do you go and buy, I wrote a book recently, 10 properties in 10 years to make $10 million? Who would like to know how to advance that formula? So what, and this is the formula I was taught by my millionaire mentor 20 years ago, okay? So what this formula is saying, if you buy, all you're going to do is once you've done this, if you want to advance it after, say, 2 years later, you've got 2 properties underway, all you then do is continue to buy one more property every year. Does that make sense? So over the next 10 years, you continue to buy one property thereabouts every year. Now, as your equity is growing, you can often draw against some of that equity to put the deposits down on future properties. You will get to a point where finance will start to become a bit of a challenge. Okay, once you start getting too much debt, obviously you'll spread the risk with different banks. So then you'll start giving some logistical challenges, but then also your income might be going up, but also your income on your properties are going up. So as you can get through that, and the banks are comfortable increasing your debt, but as your equity is increasing, they're happy to loan you more money because you've got enough equity. Especially if you don't cross-collateralize and things like that, try and keep each property separate. Banks will try and get their hands over all of it. That's why you need to see finance professionals. Otherwise, they'll screw you, the banks. If you're a novice, they'll go, okay, we'll loan you this money, but we're taking security on your house, taking security on this. There's no need to. The property should stand up on their own accord. And you don't the banks will take security on anything they can get. So novices, and people sign up, yeah, okay, I'll agree to that. Never agree to that, okay? What you're going to do now, by buying a property every year over 10 years, if you run the numbers on that, by the 20 years later from when you started, you would have approximately $10 million in net equity. Does it make sense? Approximately $10 million in net equity in 20 years. Is that a pretty good retirement package in 20 years, yes or no? Yeah. Is it better than the pension plan? Yeah. Better than no plan? Now, obviously, you could also accelerate that some more. Now, we have clients that have already done that. There's many clients already on that process over the years of working towards that plan. But it actually gets easier over time because once you've done it, and there's some clients that just buy another property every year. Okay? And it's just a simple part of that plan. And long term, they're looking at an incredible amount of wealth. Does it make sense? Who's excited by that, by the way? Now, is it necessarily easy? Not necessarily easy, but is it simple? Yeah. It's incredibly simple. Now, then you've got to say, well, where do I buy these properties, etc. Now, how you improve the results is where you buy them, by buying better quality property, buy them at a good price, etc. At the time of the cycle as well. Overall, the cycle is going to average out. You've got to understand that property doesn't increase the same every year. You'll get 4 or 5 or 6 years of more flatter growth, then you'll get 3 or 4 years of more faster growth. What you're at the beginning of right now, why I'm bullish on Australian property, is you're at the beginning of another cycle of 3 to 4 years of more rampant growth. Then what you'll see is more likely to be more flat growth for a while. Making sense? So if you waited 3 or 4 years to start this, you'd be more confident in the sense that, wow, I've seen property prices go up, but now I'm starting at a cycle where it's going to be more flatter. Still good to be in the game, but I would say get in the game now and let that next 3 or 4 years give you that good growth quicker. Who's following what I'm saying here? That's why I'm bullish on Australian property, and that's why I'm not concerned. The Reserve Bank will certainly work to stop a property bubble happening. When the media is making exaggerations, oh, do we have a property bubble? It's just premature. We don't have a property bubble yet. Will we have one? Well, rampant growth took off and was get out of control and the banks started reckless lending like they did in America. Yes, that could happen, but it's unlikely that they're allowing that to happen. And that's just the way that it works. Quickly turn to the person next to you and teach them how to make $1 million in 10 years or $10 million in 20 years? And decide what do you want. Go for it. Okay, I'm going to take a few questions. Does anyone have any questions at this point on what we've covered so far? Any questions? Yep, grab a microphone. We'll just fire away. Is it making sense to everyone? Now, some of you will be like, with a mistake, some people are saying, why haven't more people done this? One of the reasons is that some people bought properties and sold them. Does it make sense? They've messed with the formula. Well, you know, a lot of people that bought and they wish they'd never sold. You often make more money just keeping them. The hard work is in the buying, doing it in the beginning. After that, there's not a lot of work to it. Far away.
Can we please have steps 7 and 8 of the 8 steps to come up with money?
You're probably thinking that he's forgot what they are, so he doesn't want to cover them. Is that what you're thinking? I know off the top of my head everything. Waiting. Yes, I'm going to go through that. But let's take a couple of questions on this first. Down the back.
Thank you. First of all, just like to also reiterate, I was very lucky because I bought property in 2001, a lot of property actually,
Yep.
and people were throwing them at me because they'd held the property for 10 years and nothing had happened. And then within 2 or 3 years, they'd all doubled and, of course, gone up. So as Jamie says, do it once, forget, makes everything really easy. Just got to get past that first step.
It's amazing when you would have first saw it as a theory that to do that, and then you go and do it and you see it happen. It's like, wow, it actually works. But then you go, well, you think, why don't more people do it? But it's funny that way.
Well, if I can just quickly share, I actually went to my very first seminar. It was Robert Kiyosaki in Singapore, and also Dolph DeRoos got up and said a few words, and it all sounded pretty good to me. I'd never heard anything like that before, so I went down to Brisbane. I was living in Singapore at the time. I went down to Brisbane and I bought 3 properties that weekend. But the interesting thing was I didn't have any money. I also didn't have any knowledge, and therefore I didn't have any I wasn't really scared until when it came in. They started giving me things like body corporate fees and stamp duty, and I thought, what's all this stuff? So for the next 2 years, I learnt a lot, right? But those 2 years was invaluable training, and then sort of moved on from there. But it's interesting because the main point of what I'm trying to share is that I bought those 3 properties and I did not have any money. All right, so it just worked it out from there, and then from then it just worked on pretty well. So my question is about negative gearing. So obviously I follow that formula 100-10-3-1.
Yep.
So I always buy positive. I actually did negative gearing for a number of years, and I didn't like it. So I like positively geared properties. But I'd just like you to clarify, the sort of really the difference between negative gearing, positive gearing, whether you prefer negative gearing. Because the interesting thing, everybody tells me negative gearing, you get a tax benefit. Well, guess what? You also get the same tax benefit in positive gearing. Yeah. So I just know that it was a lot easier for me to continue moving forward in positively geared properties rather than negatively geared.
Yep, very good. It's a good question. For those, positive gear, for those who aren't familiar with property, is simply that the rent is more than the expenses, more than the mortgage and the expenses, so you don't have to put any money in your own pocket. It probably really depends on your cash flow. I have no issues with negative gearing. I think, if that's all you can get into, then by all means get into it, because a plan is better than no plan. So it depends on your cash flow. If you've got a decent income, then negative gearing is not going to be a problem, because you're going to write off a lot of in tax and you can fund it. So it's not going to put stress on you. Or you can do the other thing and diversify, go for some positive, a lot of if you speak to the property team, what they will recommend, their advice will be, get some bit of both, so you're balancing it up. Or what a lot of our clients are doing is they're using US property as the more positive cash flow to supplement with Australian property, which isn't as high cash flow. So there's probably no right or wrong answer, depends on your situation. If you've got a pretty solid and larger income, you're probably not going to be too bothered by negative gearing. If you're a bit borderline on your income, you might be pushing more for positive geared properties. Now in Australia, it's much easier now to get positive geared property. Why is that? You can tell me. Interest rates are quite low. So right now your interest rates are at record lows. So that's also helping the property market. But you have to factor that in, that when you're buying now, the banks will pretty much assume that they'll plus 2% they'll buffer that, in 2% increase on real interest rates. And my belief is interest rates are likely now to go up as opposed to they won't go down further, unlikely. But they probably won't go anywhere for a little while. But the next movement is more likely to be up than down. But that's who knows for sure. The interesting thing with interest rates is that it's great on debt that you own when interest rates go down. You get excited. But as I'm an entrepreneur, usually interest rates going down means the economy is not looking too good. So you might be losing in business income, gaining in the savings on interest. So it's so if interest rates are going up, some people don't like it, but it's a signal that the economy is expected to be, so you can benefit on one side and you're paying more on the other. So it can sort of diversify itself out. I'm not saying this has to be a negative gearing strategy. Whether it's positive or negative is really irrelevant, or not irrelevant. You can do both or either, or you might just prefer positive geared property. You just have to look for those sort of types of properties, and it's much easier to get them now when the interest rates are much lower. Make sense? Any other questions? Yeah, right down the back. Does anyone have any examples of properties they bought years ago, how much they paid? It'd be good, actually, let's do that. Just before I answer the question, can people yell out some examples of what you paid for property 10, 20 years ago? Because we could just show people that haven't seen how much they go up. Yeah, just yell out some, yep.
I bought one for 140 in 1997.
So 97.
So that's worth 900.
So 1997.
And the average
And it's worth what, sorry, 900?
900.
And what city?
In Scarborough, Brisbane.
In Brisbane, yep. So 97, we're talking 16 years. You see sometimes the formula gets out of whack a little bit. Apologise, okay? But in Brisbane in particular, you'd have a lot of references of that because why? Because Brisbane before that, certainly then, for a 10, 15-year time frame had been very flat. So it had a lot of catching up to do. Gold Coast was another one there for a while that people sat on their properties for a decade. It hadn't really risen, mainly because they paid too much for them in the beginning. And then they sold. They didn't realize they sold just before the boom, and then property doubled in this 2 or 3 year period. So then they were kicking themselves. So once you're in the game, if you can afford to fund them, just stay in the game. It's eventually, remember the 10-year cycle, if you're going 5 years and the cycle hasn't increased by 50%, doesn't mean the plan's not working. It means you're being in part of that 10-year cycle, getting flatter growth. The next 5 years are likely to see that faster growth. Anyone else? Any others? Yep.
Old enough to make some horrendous mistakes, and that's why I teach people they're not to make the same as I.
Yeah.
And that's part of education as well, to show people not making mistakes. My first property was $21,000.
So 21,000, yep. That's in Melbourne?
Which is Collingwood.
Collingwood, Melbourne, yep.
That's a two-bedroom-
What year?
1985.
1985,
And
yep.
that was a two-bedroom solid brick terrace with a mezzanine roof.
Yeah.
So not a bad property. I sold that in 1993 for
Yep.
123,000 because I was told by a lovely agent that I had to. That was a good value and a good improvement. That's not bad.
What's it worth today?
Around about 600 grand.
So it's worth 360 today?
600.
600 today, sorry, yep.
And the other mistake I made was in a place called Seddon, which most people might know near Footscray.
Yep.
I bought a renovated, being a real estate agent earlier on, I was offered property. And one of the people I helped out, because I needed a deposit to buy property,
Yep.
was to sell their recently renovated two-bedroom weatherboard, new roof, new extension, new bathrooms in Perry Street near the railway station.
Yep.
And they needed 28,000, so I helped them out.
So you bought it for
28,000 in 1989. And
89,
I
yep.
paid 28, and I sold it for 64,000 because I had a bad tenant. I wanted the tenant out, so I sold it.
in what year?
6 months.
Yep. Wow. Yep. So you bought well.
And today it's $600,000
600,000.
without any doubt.
So you're a good example of one you've profited from it, but you can see now he's kicking himself because if he had just held the properties. Okay. It's the time. Time is on your side. Is that pretty amazing? If those who aren't into property don't understand it, go and do your own homework, go back in time, and you'll start seeing this stuff over and over again. All of a sudden you go, this is actually real, this is not hype, this has happened. Now, obviously it varies in different suburbs, etc. You will get cities like Brisbane that were flat for some time, Adelaide, etc. But certainly in the last 10, 15 years, most cities have had some sort of decent growth for large portions of that time. So some people go, well, they've risen so much, how can they continue to rise? What you've got to understand is when you're leveraging in property market, just by sheer inflation, is that properties will likely rise in the future substantially. Inflation is on your side when you're buying property. Inflation is more the enemy of the banks than it is you. Inflation, if you borrow $1 million today, in 10 years due to inflation, that $1 million, if you still owe it, is not the same $1 million you borrowed. Inflation is on your side. Remember, inflation, it's the Reserve Bank and the banks that worry about inflation because their loans have extended to you are devaluing. Okay, so inflation is not such the enemy. If you're leveraged into property, if you just got cash in the bank, then inflation is a problem because it is eroding the value of your money. But in real estate, you're leveraging inflation in the sense that it's working for you. So if you're leveraged at, you put 10% deposit in, you're leveraged 9, or effectively 10 times, say it. Therefore, if inflation's running at 3%, inflation's making you 3% times 10, inflation alone is making you 30% gains. Does it make sense? So, and people don't look at it that way. You're leveraging inflation. So there's a lot of great examples of what can happen where a lot of people, even developers, would buy a house, develop a house, and then sell it and move it to the next one. And if they had to just try to hold on to some more of their property, then it would have made so much more money. So buy and hold, there's a lot of different strategies, but buy and hold is certainly a very profitable one. Let me ask you a question. Who's sold property that wishes they had kept more of them? Yep. Let's just go over here very quickly. Yep. Your question, yep.
My young son here wants to know whether he can get into property investment before he turns 18.
Before he turns 18, or if he has a dad, that would certainly help. You certainly can. There's no, you just need someone to go guarantor, or as far as getting the loans, etc. But there's no age. There's no reason why you can't stop a property portfolio. Instead of helping, what would you rather if you're a parent? Would you rather your son or daughter to come to you, Dad or Mum, can you go guarantor to get me a car loan? Or can you go guarantor, I've really been doing my homework and education and research on a property, I want to go into a property. What would you rather? You'd rather into a property because then they're building and adding on to their wealth, and also you have security, so if they stuff it up, you can just take their property, okay? So you're protected either way. So where a car, they're going to, is a guaranteed loss, okay? People buy a car because they think that equals freedom, okay, when property can equal their freedom. Who's excited, by the way? It's really exciting, and obviously, now you can get that book, you can download it for free, 10 properties in 10 years. I think we gave it away recently, so you can get access to that for free. Conrad will cover more but on the property, but you can speak to the property team at 21st Century, and they can run through, if you want a personalised plan around this, when they can do it based on your income, and they can do that for you. You can start to tailor it to your needs. Let's take a couple more questions, and let's then continue on the other exciting things that we have to learn. Yep. We'll go here.
Yeah, I didn't want to sound negative, but is there anyone who has an example of a house that they ever regret buying? Because I haven't usually heard of that case.
Yeah, sure, yeah. Yeah, I've had some bad investments that, yeah. Okay, yeah, it's good. It's a good point. That's what I was going to cover as far as areas not to buy. Yep, far away.
Again, mistakes that people make is why I try and recover and help people recover from making bad mistakes. I've just spent 9 months renovating the worst mistake I've ever seen anyone buy after I've suggested they go and buy a property. I just sold their property with the help of another agent, because being an agent, I don't want to be too close to some people, so I actually find an agent for them. We sold the property they sold, $30,000 above what she was going to take for it. No, I'm happy, I want to sell. It was a terrible property we sold. She went and bought one in the same suburb, Templestowe. You'd imagine Melbourne, Templestowe's a bit nice area to be. She loved the park behind it. The land was on 650 square metres. The average in the area is about 800. The house had termites, rats, I found them, bad plumbing, bad wiring, bad structure. They had a plan done by an architect. $7,000 to renovate. Normal plans are around $1,500. These are the kind of people who will pay because they've got money.
Yeah.
9 months later, the house is livable. Is livable. The whole place should have been knocked down.
Yeah.
Total knockdown.
Yeah,
Water
and
damage,
basically,
rats,
if you're doing
everything.
your basic tests, you wouldn't have bought that.
Termites.
Yeah.
It was a flat roofed house.
Yep.
Bad foundations. Everything in the house I pulled out.
Yep. So what you would do is that you'd have all your checks done, which is standard. Your lawyers will do it for you before you buy. That would do all the tests to make sure that the house is sound. But as far as I think what you're asking is maybe more the areas, which I was going to allude to. Okay, I'll tell you where, if you really want to stuff up this plan, buy Gold Coast high-rise apartments. Absolute disaster. Never touch them unless you're getting them at ridiculously bankrupt prices, and even then I would worry. Docklands, not a good area to touch either. In other words, what you're buying a tenant, so you don't want to buy high-rise apartments. You generally stay away from. Okay, generally stay away from them. Why? Because there's 100 apartments in one tower. If one person has to sell desperately, and sells cheaply, what's it do to the value of yours? It brings it right down. Okay, because you've got the same product as everyone else in the same area. So I'd stay away from those. Two, the other reason, body corporate fees. A lot, especially Gold Coast, is a scam for that. So a lot of people go to the Gold Coast for a holiday, nice apartment, and they go, oh, and then they get sold to buy, and it's like, oh, this would be great. Don't buy those high-rise Gold Coast apartments. They're the biggest rip-off you'll ever see because you'll be paying extensive body corp. You'll never own them because you basically rent them off the body corp. So there, the Docklands has been horror for a lot of people. Doesn't mean, if you live in Docklands, you don't get some capital growth eventually, but if you don't mind a lot of grey hair before you get it, then that's fine. So there are areas you'll tend to avoid. The only exceptions would be if you're getting a super distressed sale, then a different story. And there was in the past few years super distressed sales on the Gold Coast for apartments that you go, okay, I might break that rule, but notice only if you're prepared to do that. So people that bought Q1, etc. on the Gold Coast, they're still waiting to recover their money. Eventually they might, but why? There's plenty of houses, there's plenty of quality place. So I won't go into that, but Conrad will touch on some of that briefly, but you can speak to them and the team, and they can give you what they do if you want help, if you become a member with some of the different property services. They will go and they have the 52-point checklist and all these things. So what you're doing is taking a property and narrowing it down to try and minimize the things that can go wrong and maximize the capital growth potential. So your 10-year plan is more likely to occur sooner than if you do it wrong, and you can take longer to achieve it. But in saying that, if we put a map up on the wall of any capital city in Australia, and we could throw a dart at the map, and whatever suburb it lands in, go and buy a property at market value or below, pretty much 10 years later, you're going to be fairly confident the house will still be there. And has gone up in value. But if we did that with the top 200 stocks on the Australian Stock Exchange, and you threw a dart and bought whatever company you land on, you don't know in 10 years whether that company will still be around. So even if you get, property can be what's called a fairly forgiving investment. Even if you get it wrong, if you're in the game long enough, you tend to get away with making mistakes. But education can save you making those mistakes. So there are particular areas. Holiday areas, etc., you want to be a bit more careful with because they're volatile. Okay, so you can get bargains, like Gold Coast, you now can buy bargains, but buy houses, etc. Don't buy those high-rise apartments. Don't buy the high-rise apartments in Docklands if you want to see this plan work, because you're not going to see it work unless you want a 25-year plan for the sake of it. Inner city apartments, some areas you'll still get growth, but you'll find that it's a different marketplace. Those prices have been driven up by generally Chinese or Asian investors. They like to live in the city, and they're pushing those prices up. You probably want to stick away from those lots of apartments in one building. That would be a big cross. Stick away from that. Conrad can cover quickly when he comes up, some of the areas that you might look for. Does it make sense? Okay, so let's go through quickly what these other three were. Equity, you can use equity. If you don't have any equity, maybe your parents do. You can go a JV with your parents and maybe use your parents' equity. If that doesn't work, maybe it's time to visit your grandparents more often. And number 8, yes, superannuation. I'm not licensed to talk about super with property investing. The regulators, you'll hear ASIC, and they're going to really pushing this. I don't know why. I mean, if you listen to what they say, it's like people should never buy property in super because it's like evil or something. I mean, it's ridiculous. I would say this: who would you rather listen to? Some bureaucrat in a government department that has no idea, probably never invested a day in their life, or a property millionaire? You make up your own mind. Who are you going to read to? Some dumbass journalist that has never bought property in their life and thinks a barren land or something is a bad thing. You know, these people, what credibility do they have? If they're out there in the game and they've made millions from it, then let's hear what they have to say. But these people that you got to understand, so what they're trying to do, because what people have figured out thanks to the credit crisis, that people lost a lot of money in super because the financial planning industry was pushing people, put your super into managed funds, etc. So the financial planning industry rakes in billions of years in fees. And of course the banks lobby to, you understand regulators are lobbied to by powerful groups. And these powerful groups, whether it's the banking group or the financial planning group, they have their little friends in the media and they push them to write stories to discredit and damage competing industries, okay? They don't particularly like people like me, and they will do everything to discredit people like me. Why? Because I cause them to lose business. If you're educated and know what you're doing, you don't have to go to a financial planner. You don't have to go to a financial planner in a bank. You don't have to sign your super away to a self-managed, to a managed fund in the stock market that pays them commissions forever. Because you go and set up your own self-managed super fund. You go, oh, maybe I'll buy property with that. I can't advise you on that, but you can speak to different professionals as they can if you want to do that. But I can tell you now, it's perfectly legal to be able to buy property in your super fund as well. And as much as the regulators are wanting to try and talk people out of it, because the industry's pushing it, you can do whatever you want. You go and get your professional advice on it. It's up to you what you do. So yes, you can use a range of different ways to get involved in investing, and that's become very popular. Making sense? Let's go through the top 10 investment strategies very quickly, because then I've got to get into Bitcoin, and then we're going to hear from Conrad. Okay? So who's getting more comfortable that as a base level formula, that if you bought a couple of properties over the next few years, that in 10 years' time, you should be doing okay? Okay? You should have increased your wealth. You should be writing stuff on the internet and say, thank God I went to that seminar. I actually followed through and did what was suggested or what you could consider, and I've done very well. Okay? And you haven't made the mistakes that some people make. Okay? Just by being educated. So that's what you can consider doing. Ultimately, it's up to you. Who's responsible for your decisions? You are. You're to decide where you're buying a property, what sort of property. When you buy it, there's all the decisions you're going to have to come up with. But that's why the more educated you get, the more comfortable you get, the more experience you get. The key to anything is to get started, okay? And then you go from there. Top 10 property investments. You probably have a copy of this. This has just been updated for the year ahead. Let's run through these very quickly. Daniel. Now, this is just really my opinion, okay? And every year, I reshuffle these subject to market conditions. Number one for the year ahead is buying Australian property, buy and hold. That's why I've spent most of the time just on that concept. Because, remember, I've been teaching for 15 years now. I see the patterns of what people do right, and I see the patterns of what people do wrong. And I continually say to people, like the clients that just followed the basic formula I've been teaching for 15 years and went and bought a few properties and didn't sell them, are doing very well now. Does it make sense? The ones that neglected that, some of them are doing well, but a lot of them, if they just did stock trading and were after the quick money, some of them made money, some of them didn't. The success rate's much different, okay? So number two is US property. What's my view on US property? I've been bullish for 3 or 4 years. I remain bullish to this day. So I'm continuing to buy US property. I think the year ahead in US property is going to be very good. Of course, there's different markets we have to move to. When we first went in the US, we went into Phoenix. Phoenix was rock bottom. And I told my investor clients when we're going to the US is that you're buying US property, but we're not expecting any gain for 10 years. We're buying to say, it never recovered for 10 years. There was no property increases for 10 years. We were happy to buy for the cash flow returns. Now, what's happened the last 3 years since we did that is that there's been some very good rampant growth in property prices in the US because they're coming off such a low bottom, particularly in the markets like Phoenix, and we stopped buying in Phoenix because they went up so much. Now a lot of our clients that bought in Phoenix, the prices have gone up, and now we have hedge funds and other people wanting to come to us and say, do your clients now want to sell those properties because they're after properties and they can sell and then move into another market? Does it make sense? So US property, it's not as easy to manage as, say, Australian property. Because here you have property managers that generally do a good job. I mean, pretty much in Australia, plus you have better quality tenants in Australia. They don't tend to trash your place. They tend to have better incomes. You don't have the amount of poverty that exists in the US. The US, when you see, is quite a poor country in a lot of ways. It's rich, but there's much more separation, So you've got to be more careful of the markets. And of course, the downside is that if you don't have someone doing it for you, you have to go over and do it, and you're busy, and sometimes that's difficult, and that limits people from doing it. Success rate of US property, I would say 9 out of 10 times has been very good. If you get a bad property and a tenant from hell, you'll probably wish you'd never done it. But if you get in good areas and that works well, then you generally, it can be a great investment. 13, 15, 18% return yields are possible. And on some particular ones, if you speak to, they'll speak tonight on that, as much as 30, 40% cash rental yields. The other thing that's attractive with US property is you don't need $500,000 to get started. So one of the reasons I like it is a lot of Australians are priced out of the Australian property market, don't have the money to get started in that, but if they can get a property for 40, 50, 60,000, at least they can get into the game. Does it make sense? So it does make it more affordable to a wider market of people. But the things that can go wrong, the things that can go right, if you get educated about that, you can minimize the things that can go wrong. And if you have a helping hand, that can also minimize the things that go wrong. Now, there's some disasters that happen. We've had some clients, their houses are burned down, okay? But they've had insurance in place, and what's turned out from a disaster has actually ended up making them a lot of money, because if they've insured it at more at the replacement value, and the insurance companies will do that, then because they've bought them so far below replacement value, because you can buy so many houses in the US below replacement value, they end up getting an insurance check for a lot more than they paid for the house, okay? So sometimes a disaster can turn into good things, but there's been cases of the US government going broke, and the debt ceiling, etc., where there's delays on getting paid if your clients are Section 8 clients, in other words, government paid clients paying the rent. Or they're going broke, so they cut the rents on you, but that's just, those things you can't control. Or you can just get tenants from hell that trash your property, and then you have to spend money to fix it and find another tenant. That can happen, but generally you want to try and avoid those areas, because once again, in property, you're buying the tenant. Does that make sense? That's your cash flow. You're buying a tenant. So I like cities particular. You can speak to the team. Everyone has their different opinions. Indiana, is one what I prefer. North Dakota is a lot of opportunities there because of the mining boom. That's where you can get those 30, 40% type rentals because of that. Phoenix in the past was great. Kansas I don't particularly like. I've never bought myself into Kansas. But Indiana and others are quite good. And then that will change as the years go on. So the US property team, they can keep you updated as the markets change. As the property market cities rise in some places, we go, well, don't buy there anymore because you're paying too much. Move to another city that's still yet to rise. Making sense? So US property, I'm still very bullish on it. There's great opportunities there. How much longer that will last for is a limited amount of time frame until the market gets back to where it was. That will take a little bit of time. Number 3, this is a new strategy you're going to learn tomorrow, okay? I think after lunch tomorrow, they'll go through this. I'll interview Chris Freeman. So this is the idea where I shared the story yesterday, how I got a friend, and what he did was that he had a house with a big block. He subdivided, cut the block in half, put a townhouse on the back, etc. So it's a pretty simple strategy. It's very effective. It's not for everyone, but it is a way that people can make $100,000, $150,000 type profit per deal, and the person could, if they wanted, you could possibly do 2 deals a year while they're doing their job, or become a full-time investor doing this. Once they're proficient at it, maybe do 3 or 4 deals a year. So it's quite a conservative strategy, I would say, in a fair way, but you'd need to have a bit of knowledge to do it. But that may interest some of you. Number 4 is Land banking has been in the top 5 for quite a few years. Land banking actually, if you look at the people that made the most money in real estate in Australia, it's actually been through land banking. All the big property companies, what they do is that, a lot of the outer suburbs of Melbourne, say, used to be farmland. Is it true? Or even regional cities, Bendigo, and all the cities. What happens is they get rezoned to residential, and then eventually developers buy them off farmers, and often they'll option them. Instead of paying cash for them, they'll option them so they can buy them in 5, 10, 15 years, and they can cut them up. So the process of going from an acre of farmland, which might be a few $1,000s an acre, to dividing up into house blocks, well, that few $1,000s an acre can now be $10 or $20 million worth of house blocks. Does it make sense? So that dividing up and rezoning is adding value, and you're happy to go and buy a house block to put a house on, and you'll pay 150, 200, 300,000 or whatever, depending where, for a tiny little block of land that used to be farmland many years ago. So that process of adding value adds millions of dollars to land. Now, that's why it's usually the big players that do it, because they can afford it. They have to buy it, pay the interest, because there's no income coming off it. But there's ways, if you can do options, you can control that asset, get the capital growth over time without having to pay any interest costs. And then eventually, when it's developed, 10, 15 years or whenever down the track, the longer the better, then you've got that capital growth. So it's a great strategy, but you probably need a bit of help to do that one. Number 5, blogging. You'll learn this tomorrow. It's not actually an investment strategy, but your time is your money as well. So I think future blogging, if anyone can do blogging, so that's why I like it. Really, there's no limitations to it. Number 6. You're going to learn this tomorrow, the share renting strategy. It's always been a solid performer throughout the years. Number 7, internet domain trading, a new one added to the top 10. You're going to learn about this tomorrow. I've convinced a friend to come along and share his secrets. We'll try and get as much out of him as he can. Some of these people don't like to give away their secrets, but we'll see. If you're really nice to him, he might let slip a few really big ones. It's I guess, if we're talking about the real estate of the 21st century, there's internet real estate, online real estate, that's what we're talking about there. People have been doing this for years. So obviously there's a methodology and strategy where people can profit from that. Domain trading is where you're buying website addresses effectively that you think are valuable, and then being able to resell them to people that will pay more for them. Okay. Number 8, Bitcoin trading. Jamie, I've been waiting for days to hear about this. Just hurry up. We'll talk about that in a moment. Number 9, network marketing. Once again, it's not necessarily a physical investment strategy. In the past, I wouldn't have put network marketing in the top 10, but I guess the 21st century methodology of network marketing, where the internet, the old school network marketing was the Amways of the world, where you used to go and harass all your friends. Most people don't like that. The new methodology of network marketing tends to be website-based, internet driving traffic, etc. So a lot of people can do quite well from that. Certainly not for everyone, but some people, savvy internet marketers, are doing quite well with different opportunities that are out there. Number 10 is Forex, and that you'll learn about that first up tomorrow morning if you want to learn about that from an expert in the morning. So that's what I would consider the top 10. That's just my guideline for the year ahead of where I see things. Things will change as markets change, but there's certainly plenty of strategies there for you. To learn more about that, obviously you're learning a lot more about these things throughout the weekend, and there's other free resources for you to study that some more.